Welcome back to Talk Tickers. This is the show where we strip away the corporate PR, ignore the fluff, and get straight to the numbers that actually move the market.
And I'm here to connect those dots and see if the story management is telling actually matches the math.
Today is Saturday, January 24th, 2026. We are looking back at a company that just finished its earnings call yesterday morning, and honestly, the reaction has been, well, fascinating. We are talking about Customers Bancorp, ticker CUBI.
This is one of those situations that just, it makes you love the market because it's so messy. If you just read the press release from Thursday night, you'd think this company just won the Super Bowl.
Right.
But if you looked at the price action on Friday, it looked like they fumbled on the goal line.
Oh, it's a bloodbath. The stock closed down over 8% on Friday. It gapped down at the open and just never recovered. And this is a stock that's been an absolute darling for the last year.
A total darling.
Okay.
Up nearly 50% over the last 12 months before this drop. So, the expectations were sky high.
So here's the mission for this deep dive. We need to figure out the disconnect. Management is popping champagne, talking about a record year, a coronation of new leadership. The market is throwing tomatoes. Is this a misunderstood fintech giant, or is it just a regional bank with a spending problem?
That is the central tension. And to solve it, we have to start with the headline numbers. Because there was a very, very specific reason the algorithms hit sell on Friday morning.
Let's hit the results snapshot. On the bottom line, they actually beat expectations. They reported core earnings per share, that's EPS, of $2.06. The street was looking for $2.03.
In a vacuum, a beat is a beat. You put up 3 cents more than the smart money expected, and, usually the stock goes up.
But the stock didn't go up. It tanked because of the top line.
The revenue, this is what the pain was. They reported revenue of $214.61 million. The consensus estimate was $228.35 million. That is a miss of almost $14 million.
Okay, let's pause there. For a bank this size, why does a $14 million revenue miss trigger an 8% sell-off? Is it the market just overreacting?
Well, it's not just the number. It's what the number signals. When you're a growth stock, and make no mistake, CUBI pitches itself as a high-growth fintech story, you're priced for perfection. Investors are paying that premium because they expect you to expand rapidly. When you miss on revenue, it suggests the growth engine might be sputtering. It forces everyone to reevaluate the multiple they're willing to pay.
So they beat on profit, but missed on sales. But here is where it gets really interesting to me. If we look past that headline revenue number, the actual core banking income looks incredibly strong.
You're looking at the NII.
Net interest income. It came in at $204.4 million. That's up a massive 22% year over year.
And that is the most critical metric for any bank. Let's clarify this for everyone listening because it really matters.
Yeah.
NII is the raw profit engine of the bank. It's the difference between the interest they earn from borrowers and the interest they pay to depositors.
Yeah.
In the current environment, seeing 22% growth in NII is almost unheard of for a regional bank. Most of their peers are flat or shrinking.
So the core business of taking deposits and making loans is actually booming.
It is. And their tangible book value, which is essentially the liquidation value of the bank per share, grew to $61.77. That's up more than 14% for the year. So fundamentally, the bank is becoming more valuable and more profitable.
Okay, so we have a revenue miss, but massive income growth and book value growth. That brings us to the story. This wasn't just a standard quarterly update. This was the start of the Sam Sidhu era.
Officially, Sidhu has moved to executive chairman. Sam Sidhu is now the standalone CEO, and he used this call to lay out the 2026 playbook.
And that playbook is aggressive, but it's not the standard banking playbook, right? Usually when a bank wants to grow, they go out and buy a smaller bank. They acquire branches, they acquire headaches. CUBI isn't doing that.
No, Sam was very clear. They aren't buying banks, they're buying talent. They call it the recruitment engine.
I love this strategy, at least on paper. Instead of buying a bank and getting all their bad loans and old IT systems, you just go to that bank, find their best 3 commercial lenders, and hire them.
Exactly. You poach the rainmakers. And the stats they revealed are pretty staggering. They said that the commercial banking teams they've recruited in just the last 2.5 years are now managing over $3.3 billion in deposits.
That is a massive number for organic growth.
It is. And just in Q4, the quarter that just ended, these new teams brought in $585 million. But here's the nugget that you have to circle. 30% of those new deposits were non-interest bearing.
Okay, let's unpack that term, non-interest bearing. It sounds boring, but in banking, it's the holy grail. Why is that specific stat so important?
Well, think of a bank like a manufacturing plant. Their raw material is cash. If you have to go out and sell CDs to get cash, you might have to pay 4% or 5% interest to the customer. That is expensive raw material. It hurts your margins.
Right.
Non-interest bearing is free raw material. It's usually a business operating account. A company leaves $2 million in the bank to pay payroll and vendors. They don't expect interest. They just want the payments to work. So if CUBI can get 40% of its funding for free, their profit margins on every single loan they write are significantly higher than a competitor who is paying 4.5% for their deposits.
So they are hiring expensive bankers, paying them big bonuses, but those bankers are bringing in free money.
That's the arbitrage. You pay for the talent once, but you get the low-cost funding in perpetuity. That is why their net interest income is up 22%. It's the recruitment engine firing on all cylinders.
And they are not tapping the brakes. The guidance for 2026 is honestly pretty shocking. They're guiding for 8% to 12% growth in both loans and deposits.
In this economy, that is bold. Most banks are in survival mode. They're trying to shrink their risk. CUBI is out there saying we are going to grow double digits. They are targeting NII of over $800 million next year.
It's aggressive. And frankly, that aggression is part of why the market is skeptical. When everyone else is retreating and you are charging forward, people worry you're going to run off a cliff.
Or that you're going to trip over your own expenses. But before we get to the bear case, we have to talk about the other engine, the one that makes CUBI trade like a tech stock.
The digital elephant in the room, Qubix.
Ah, yes, the tech moat.
For the longest time, people looked at CUBI as a crypto bank. Bitcoin goes up, CUBI goes up. But listening to the management team now, they're working very hard to kill that narrative. They don't want to be the crypto bank. They want to be the infrastructure bank.
Payments is the new buzzword. And look, the rebranding has merit. They dropped a number on this call that made me do a double take. They stated that Qubix processed over $2 trillion in payments volume in 2025.
$2 trillion with a T.
It's a massive number.
Management even claimed that this volume puts them ahead of household names like American Express and Visa in terms of commercial payment network volume. I have to ask you, is that real? Can we really compare a regional bank in Pennsylvania to Visa?
You have to take that with a grain of salt. It's CEO math. See, Visa processes billions of tiny transactions. You buying a coffee, me buying a sandwich. That is technically difficult.
Right.
Qubix is processing B2B settlements. These are massive lump sum transfers between institutions. So $2 trillion in volume on Qubix is different than $2 trillion on Visa.
It's fewer transactions, but much larger value.
Exactly. But, and this is a big could be, but it is still an incredible amount of liquidity moving through their system. It proves that this isn't just a toy for crypto day traders. This is institutional plumbing.
And speaking of crypto, we did see a lot of volatility in Bitcoin and other assets in Q4 of 2025. Prices were swinging wild. Did that hurt them?
That was the fear. The fear was that when crypto prices tanked, the deposits would flee the bank. But they didn't. Qubix balances remained stable, hovering right around $3.9 billion. That tells us the customers are sticky. They're using the platform for operations, not just speculation.
And now they are taking that platform and pointing it at a new target, the mortgage industry.
This is the smartest strategic pivot I've seen them make. They announced a new vertical that they believe could add $50 billion in transaction volume.
Why mortgages?
Because the mortgage industry is stuck in the 1980s. It is paper-heavy, slow, and expensive. Closing on a house involves wires, escrow accounts, waiting for funds to clear. It's a nightmare.
And CUBI thinks Qubix can fix that.
They believe they can put those payments on their instant rails. If they can make mortgage settlements instant 24/7, 365 days a year, that is a massive value proposition. It diversifies them away from crypto and embeds them into the real economy.
Okay, so let's recap the bull case here. We have a recruitment engine bringing in free deposits. We have a $2 trillion payments network that is stable. We have a new mortgage vertical. We have double-digit growth guidance.
It sounds like a slam dunk.
So why is the stock down 8%? Why are investors running for the exits? We have to look at the bear case.
It comes down to one very ugly word: expenses.
The cost of doing business.
All this growth is expensive. The 2026 expense guidance is $440 million to $460 million. In Q4 alone, their non-interest expense was $117 million.
That is a lot of cash going out the door.
And when you dig into what they are spending it on, it highlights the risk. They spent $1.9 million in Q4 just on legal fees related to onboarding new banking teams.
Wait, $2 million in 3 months just for lawyers?
When you poach a team from a competitor, that competitor usually fights back. There are restrictive covenants, non-competes. CUBI is fighting legal battles to acquire this talent.
So the market looks at this and sees a spending problem.
They see negative operating leverage in the short term. Because of that revenue miss we talked about, right now, expenses are growing faster than revenue. Investors are saying, you are writing huge checks for these bankers, but we aren't seeing the payoff yet.
It's a timing mismatch. The expense happens today, the revenue happens tomorrow.
It's the classic J-curve. And in a market that is nervous, investors don't have patience. They see the burn rate and they get scared. They want to see the efficiency immediately.
There was also a specific credit issue that popped up. Generally, CUBI has very clean credit, but there was one loan.
The infamous $101 million loan.
That is a big ticket.
It is. The single commercial credit went into non-performing status. Now, management says they have an agreement to resolve it in Q1, basically selling it or working it out so they aren't panicking. But it highlights a risk called concentration.
Because they are a smaller bank doing massive deals.
Exactly. If you have a loan book with thousands of small loans, one going bad doesn't matter. But CUBI hunts whales. When you hunt whales, if one of them gets sick, it impacts your whole portfolio. That $101 million loan caused their credit metrics to tick up visibly. It's a reminder that their strategy carries lumpy risk.
So we have high expenses, a revenue miss, and a credit scare. But I want to zoom out for a second. We have to look at the valuation context.
This is the most important part of the sell-off story. Before this earnings report, CUBI was on an absolute heater.
They were crushing the index.
Over the last year, CUBI was up about 48%. The regional bank ETF KRE was up maybe 7%. CUBI had massively outperformed.
So this is valuation digestion.
That's the polite way to say profit-taking. When a stock runs up 50%, it is priced for perfection. It cannot miss. The moment CUBI missed on revenue and showed high expenses, all those people who bought a year ago decided to cash out.
It feels like an identity crisis. Management is screaming, we're a fintech, value us like PayPal. And the market is saying, no, you are a bank in Pennsylvania with high legal fees. We are valuing you like a bank.
That gap, the gap between the fintech dream and the bank reality, is where the stock is living right now. And frankly, that is where the opportunity might be.
Which brings us to my favorite part of the show. We've looked at the numbers, we've analyzed the strategy. Now let's get dangerous.
I can hear the legal disclaimer coming.
You know the drill. We are a podcast. We are not financial advisors. Do not buy stocks because 2 voices on the internet told you to. Do your own diligence. But if we were sitting in a hedge fund war room right now, pitching a trade on CUBI, this is what it would sound like. This is the not financial advice segment.
All right, lay it on me. What's the play?
I call this the rate cut arbitrage. Or, if you want to be flashy, the free money pair trade.
Free money. I'm sure the compliance officer just fainted. Explain the setup.
We are entering a falling rate environment. The Fed is cutting. Everyone knows this. In a falling rate environment, traditional banks get squeezed.
Right, because the interest they earn on loans drops faster than they can lower the interest they pay to depositors.
Yeah.
Asset sensitivity crushes margins.
Exactly. But I am pitching long CUBI.
Why?
Because of Qubix. Because of those $3.9 billion in zero-cost deposits. As rates fall, CUBI has a massive advantage. A huge chunk of their funding costs nothing. So while other banks see their margins shrink, CUBI's margins are protected. We actually saw their net interest margin expand to 3.40% this quarter, while peers are compressing.
So you are betting on their superior funding structure. What is the short leg?
You short a generic regional bank. You find a bank with high deposit beta.
Deposit beta, meaning a bank that has to pay high rates to keep customers.
Exactly. You find a bank with no tech, no stickiness, that is paying 4.5% on CDs just to survive. As rates drop, their loan yields will crash, but they will still have to pay up for deposits. Their margins will evaporate.
So you buy CUBI, you short the dinosaur bank, you are betting on the spread between tech-enabled funding and commodity funding.
Precisely. You aren't betting on the stock market going up or down. You are betting that CUBI's machine is better than the dinosaur's machine.
It's a logical thesis. If rates fall fast, that free money moat becomes incredibly valuable.
And here's the kicker. The lottery ticket inside the trade.
Go on.
The mortgage network. If Sam Sidhu is right, if they actually onboard $50 billion in mortgage volume, the narrative changes completely. The market finally realizes CUBI isn't a bank. It's a software company that accidentally makes loans. Software companies trade at 20 times earnings. Banks trade at 8 times earnings. If that multiple expands, if the market re-rates CUBI as a fintech, the stock doesn't just go up 10%, it doubles.
That is the blue sky scenario. But I have to play the skeptic. That trade relies entirely on execution. Sam Sidhu has to integrate AI, overhaul the mortgage market, and keep recruiting bankers without letting expenses blow up. That is a very difficult tightrope to walk.
That's why it's a trade, not a treasury bond.
Fair enough. It is definitely an asymmetric bet. If the tech is real, the stock is cheap at these levels. If the tech is just marketing fluff, it's a value trap.
So let's wrap this up. We have a bank that beat on earnings, missed on revenue, and got punished by the market. But underneath the hood, the engine recruiting and payments is revving up for 2026.
Management is confident, the growth targets are massive, but the expenses are high, and the market is in show-me mode.
The 2026 playbook is open. The question for you listening is, do you believe Sam Sidhu can pull off the transformation? Or is that expense guide a red flag that they are flying too close to the sun?
We will be watching the ticker to find out.
That's it for this deep dive into Customers Bancorp. Thanks for listening to Talk Tickers. Keep your eyes on the tape, and we'll see you next time.